When gold gaps up at the open, it is rarely random. Markets do not leave price always without a reason. A gap is urgency, a gap is imbalance, a gap is money repositioning before most traders have even had their morning coffee. Hello traders, welcome back to Nova channel and let's continue another new topic today. The recent surge in gold came after escalating war fears between the United States and Iran. Geopolitical tensions inject one thing into financial markets immediately uncertainty. And when uncertainty spikes, capital does not disappear, it relocates. Gold has always been the emotional refuge of global capital. When investors fear instability, they rotate out of risk assets and into perceived safety. Stocks weaken or surges on supply concerns, volatility expands, and gold becomes the psychological anchor in a chaotic environment. But here is the real question serious traders should be asking. Was this gap simply a temporary fear reaction, or is this the beginning of a larger structural trend? The difference matters. A fear-driven spike is explosive but fragile. This is powered by urgency, not by structure. In this scenario, price often gaps up, runs aggressively, and then begins to stall when the immediately panic is absorbed. Urgent buyers take profit, late buyers hesitate, volatility compresses. If tension headlines soften, price can retrace quickly because the moves were driven by emotion, not sustained accumulation. A structural trend, on the other hand, behaves differently. After the gap, price does not collapse. It builds. Pullbacks are shallow. Buyers defend dynamic support. Higher lows begin forming. Momentum cools slightly but remains directional. The market accepts higher prices instead of rejecting them. The chart tells you which environment you are in. If gold holds above the gap zone and continues printing high with controlled retracement, that suggests institutional positioning rather than panic buying. If price struggles to hold the breakout area and repeatedly wicks from resistance, the move may simply be volatility even rather than the rhythm shift. Another factor to consider is macro alignment. When war risk pushes oil higher, inflation expectations can rise. Higher inflation expectations complicate the central bank policy. If rate cuts become less certain, while geopolitical stress remains elevated, gold can find sustained demand from multiple angles. In that case, what started as fear can evolve into trend. However, traders often misinterpret the first impulse as confirmation. The market does not reward anticipation, it rewards observation. A gap is not a signal to chase, it is information that something has changed. Your job is to determine whether that change is temporary shock or structural repricing. Safe haven flows are powerful, but they are still reactive. Trends are slower, steadier, and supported by continued acceptance at higher price levels. So the real edge in moments like this is not predicting headlines. It is watching how price behaves after emotional pursuit faded. Does gold consolidate near the highs? Does gold consolidate near the highs? Does it attract buyers on the pullbacks? Does it break new ground with their immediate rejection? Fear can start a fire. Structure decides whether it keeps burning. Right now, gold has shown urgency. The next sessions will reveal whether that urgency transforms into sustained momentum or fades into a retracement, because the gap itself does not the story. The reaction after the gap is. And that is the topic today. Thank you so much for your watching, and don't forget to like and subscribe Nova channel to receive more useful video for your trading journey. Happy trading and see you in the next video.